Hello everybody, it's me the Boss Hog, and today we're going to look at what I've been doing for the week ending the 28th of Jan. Pretty wild week in the market and an incredibly active week for me trading wise. Let's do it. So definitely a loss-making week, just over 3% in terms of that. What that looks like as a percentage, pretty big, one of my biggest weekly changes. I was caught up in it up until this week. I felt like I'd been weathering January relatively well, specifically because I'm quite heavy in UK stocks, lots of value, etc. And the UK, especially the FTSE 100, is actually profitable for the month of January. There's been a real sort of rotation into FTSE, so that's really benefited me. And also I still have quite a lot of value and recovery plays, which had also been doing just fine. However, a lot of those sort of fallbacks, National Express are a pullback. This is my largest holding. That's at least partly because they're due to acquire a very large bus company called Stagecoach. But basically the regulator stepped in and said, yeah, we'd like to have a look at that in a bit more detail, please. So that's unfortunate. I think, to be fair, there was always going to be some concerns around the coach aspect of that integration, but it's just a little bit unfortunate because National Express had already lined up some disposals, had a willing buyer, and then this happened. So I don't think in the medium to long term it really changes too much, but obviously there was some concern in case that how that shapes out, so understandable. I'm actually considering actually buying more National Express shares if it goes underneath 240. Currently it's in like the 250s, so I'll keep an eye on that anyway, because I think, like I say, my medium to long term here, 1 to 2 years, is a target price of 320. So I'd been selling out at sort of 27x to try and release capital mostly, because I felt like there was better value elsewhere. But yeah, so that'll be interesting. Games Workshop, this has got pretty beaten up since it released the results. I didn't think the results were that bad. I did a whole video on it, and I've been buying into it, but obviously it continues to slide. Genius, we'll actually talk about this a bit more in a second, but another minus 8%. Poly, which is meant to be my gold and silver hedge, continues to get beaten up, so minus 14% on a week. Not really doing its job this week in terms of hedging against inflation and volatility. Hollywood Bowl, this is a company that ran up a little bit, and I actually profit took about a third of my share, but I still have a pretty big stake in it, so minus 6%. Everaz is an interesting one as well. We'll talk about this a bit more in a second. Vici here finding some love in the REITs. I think I bought some of this. I've been adding to my exposure in Vici. I think it's a good company. It's obviously only got a limited history, but I've been enjoying getting my REIT exposure a little bit back up. And then lastly, Persimmon here, this is a UK house builder. Again, I've opened up positions in house builders relatively recently because the government plans to tax them a bit more heavily because of a cladding scandal that happened here in the UK. I still think the underlying fundamentals of the UK housing market are positive for house builders, and Persimmon is a very heavy yielding, one of the best run. So again, I think this is absolutely fine. Partly the reason for the thumbnail this week, but I felt pretty beaten up. I felt like rammed was an appropriate word, mainly because I can't use the F word on YouTube, I don't think. So this week was pretty nasty for me. You can see there I had 2 4-figure losses. I did have, I guess, one profitable day, so that felt nice in the middle of the week, but pretty tough. Yeah, this was a nice surprise actually. So I had some capital added. This wasn't really the plan, just because our money's running on fumes at the moment. It's all in the stock markets or elsewhere used, but basically I took part in some niche market research, is what I've called it. I can't go into the specifics, but basically I was asked to some opinions about billing and payment software from a company that put me in touch with another company. It was about an hour and a half's worth of work, so it was paid at $400, so that was pretty nice, and that's probably all I can say on it. So I have in the past done these kind of consultations when there was an update a few years ago on UK telco regulation changes, and that's really, again, a niche area of expertise for me. And I had I don't know, 10 12 consultations. They weren't quite paid as well as this one, but they were still 3 figures an hour, so that was really nice. So these sort of things come around very rarely, but they're nice when they do, because they tend to pay extremely well. So that was nice. When that happened a few years ago, I was suddenly really popular for my opinions about what this meant. This is slightly different. It was, like I say, a company that wants to be doing this kind of stuff a little bit more, and they were basically talking to me about what I would expect from that kind of software and the tools, etc. So that was nice. And actually, to be fair, the third party paid me super quickly, so I was really happy to the first time I'd used them or had that. So that was nice to have that. You'll see here as well very material levels of trading. I mean, this is about 12% of my portfolio value, right, in a single week. You'll see in a second what that looks like. I think I timed some of these quite well. I've said financials here, but actually some of the tech, some of the quality tech that I bought, actually I timed the dip quite well. I think I'm already up sort of like 4 or 5% on it, so pretty good in a single week. Of course, the market's all over the place at the moment, so who really knows what that will look like in a week's time. But yeah, I guess that's an intro summary. Let's have a look at what I've been buying, which is a massive list. So let's get to it. By the way, before we go any further, I've just realised that I've got happy birthday on the wall behind me there. It's my little one's 2-year birthday this weekend, so that's part of the reason why this video is a bit later as well. So just in case anyone's wondering, it's not for me. But yeah, you can see here, this is my biggest list of unique shares that I've purchased ever, I'm pretty confident in saying. I'm going to start here. I think this is worth spending a minute or two discussing. So this here is Genius Sport. I've made some money historically trading them. Currently though, I'm on a really big unrealized position loss of like 4,000. And I decided not to average down previously just because honestly I didn't want to be throwing like good money after bad. And to be fair, I was even to the point where I'm like, do I just crystallize this loss? Like, it would hurt, of course, but you know, sometimes you make mistakes. Anyway, I went on their investor day that they did on, I think it was the 27th. I was really impressed, like super duper impressed. I was really impressed with the professionalism, considering it's a fairly small company. I've been on quite a few earnings calls, several investor day relations as well. It was really confidently and professionally done, like. And what really convinced me to sort of start averaging down was the fact that like they did a great job of like basically splitting apart their business and saying, listen, before the SPAC, you know, acquisition went through, we're a profitable company. All of our mature operations in Europe, you know, their net profit is sort of, you know, in the 20% region. They have good steady growth there, great CAGRs, etc., etc., right? And what they're basically doing is using that positive position in one part of the business to basically build a position in America, which is kind of, you know, seen as this new frontier. You know, the liberalization of gambling in America has got huge potential. Certainly as a Brit who frequents casinos to play poker, it always amazes me at the kind of offerings and the difference of approach in casinos and gambling that Americans have compared to Europeans. It's very different, and you know, like that, I think it's a consensus, but I think for a very good reason. You know, and like they had a very consistent vision, which was obviously part of the message, which was, listen, we're going to be profitable from 22 and 23, so this year and next year they're going to be profitable, you know, and you're still only looking at about 10 million for the year, right? So not huge numbers. 15 I think it is actually for this year, but then from 2024 they're going to be extremely profitable, you know, and that was the wording that they kept on using. So to be fair, like their forward PE, if you take it to 2024, you're looking at like a forward PE in 2 years time of like 15. So it's still not exactly cheap, but suddenly I see like a very clear way to profit, right? Like this isn't a company that's kind of really struggling. It's a company that's building a really cool suite of tools in America. Lots of exclusive content, lots of kind of value add software, some smart acquisitions in my opinion, and yeah, really good investor day. So I decided to put quite a lot of money at this, at the $6.06 I think it was I got as an average. These figures are in pounds. And yeah, so I brought my average down to 9.5. So again, this is still pretty significant red at the moment, even after bringing down my average to that. But now I'm actually really confident in the kind of longer term future of this business. So I will be continuing to buy at sort of the $6 levels that the shares are currently at. And we just take it from there. So yeah, really impressed with the investor day. It's definitely worth a view for anyone who's interested about opening a position. I've used this term before, the Yank banks. My general opinion is that the UK has better insurance and the US has better banks in terms of investments. That's how I generally view that. Previously, I've done very well out of JP and Huntington Bank shares, HBAN. This time, however, I went for Goldman Sachs and JP Timed this really well, it seems, on both buys. I think Goldman Sachs especially is a screaming buy at the moment. You know, it's actually not much above its book value, very modestly, for a very powerful consistently reliable bank, basically, from an investment perspective. JP Morgan trades on a much higher book value multiple, but still, I mean, it's an incredibly well diversified large bank. So again, I don't mind opening a position in the low 140s, which is what I was getting for JPM. So really happy with both of those. Speaking of, I'm back into realty income. I had a small stake in a lot of REITs when I first started investing. Decided they weren't really for me. And maybe convention says that, you know, when the market's a bit iffy, REITs aren't really the place to go. I totally get it as well, in terms of like REITs are going to be one of the losers, you would imagine, if if base rates have to go up for the interest. But you know, like O is just a really great company. It had a bit of a wobble to the low 66s. I think I got this for 66.22. That just felt like a great time, and you know, I'm really happy to get 20 shares in this. So you know, it's like a mid-sized position now, about 1% of my portfolio, give or take. And yeah, it just feels really good to have, you know, this. So I took advantage of it all the same. Speaking of, I opened a new position in Google and reopened a position in Broadcom. Broadcom was a company I sold, I think, about 490 that I regretted selling many months ago now, honestly. Google I've never been in before, but I think it's one of the more valued plays in the tech space. And yeah, I got both of them at good prices. Broadcom especially, I timed almost perfectly. I was a bit sad I only got one share, but you know, that's okay too. And Google, you know, I picked up a little bit more, and yeah, this felt good as well. I'll be buying some more of these if I get a chance to, so it feels good. EVR, I do just want to take 30 seconds here as well, because you know, this is basically my iron ore play of choice. This is the fourth time now I think I've been into EVR. I'm gradually building up a sizable position again though. In my opinion, EVR has had a bit of a disconnect from its iron ore price, and over the last 18 months it's kind of traded a bit above that relationship, mainly because its mines are based in Russia. It's not had any issue at all exporting them to China, whereas the likes of Rio Tinto, their iron ore mines are in Australia, and you know, therefore China's got an embargo against buying stuff from Australia at the moment. You know, it's desperately trying not to, and it's kind of benefited by being kind of in that grey area more than sort of Rio is, for an example. But currently, as a combination of the fact it's divesting its coal arm, you know, and that's going to be listing on the Moscow Stock Exchange, so a lot of people are being forced to sell it. I'm pretty agnostic about that. I'm also going to be forced to sell it. That's okay. I'll take the cash when it comes back. Really here though, more the reason why the price has fallen, I believe, is that it's 55% owned by like 5 oligarchs, and if there's any sort of sanctions, these are the kind of oligarchs that have very good relationships with the Kremlin and are likely to see some kind of penalties, right? The largest stakeholder here is Roman Abramovich. UK investors will know him from owning Chelsea, but you know, the guy hasn't been able to step in the UK for a couple of years just because the UK government refuses to let him. So it's a bit of a weird one. But yeah, I think like if you look at the names of those investors, certainly 4 of them, the smallest one maybe won't, but you know, like this is a political risk, but for me, you know, this is just a good chance to buy EVR because it's a profitable company. I'm pretty agnostic about the coal divestiture. I see the pros and the cons of that in the medium term, basically, and yeah, I think it's now actually quite disconnected from the iron ore price, which has seen a recovery over the last few months. So to me, I mean, I'm picking up shares here under 500. That just feels really great. And yeah, I guess my average this week was 502, but again, I feel really great about that. Like for me, this is this should be about 600p share. So you know, I'm basically picking this up at a 20% discount, so that feels good. And I'm expecting still a decent sized dividend this year from this, although it won't quite be as good as previous years. EVR has a reliable record of being the highest dividend payer in the FTSE 100, and again, it's still going to be in the FTSE 100 even once it divests its coal. It's by far big enough. So you know, this isn't a Mickey Mouse company. It's a long-term constituent of the FTSE 100 with a track record as well, I feel. So yeah, that was the rationale there. And last but not least, this is a shares that I sold out of previously at 24. This is actually my first, I think, stock analysis video. For me, FEVR is somewhere between 21 and 28 pound a share, and I know that range is more or less useless, but I think it's important to give it that range because for me, the success of FEVR is based on 3 things, right? It's going to be based on its international sales, its success getting into other mixers away from gin and tonic, and its success with keeping what they class as off-trade, so retail sales basically via supermarkets, etc., rather than in pubs and restaurants, right? Fever basically plummeted from what had been a relatively heavy price of like £28, which probably was a bit ahead of itself, to be honest with you, until those things clarify. But it crashed under like 20 quid. For whatever reason, Fever does seem to have very volatile changes when earnings come out. It's nearly a £3 billion company. It would be pushing on the door of the FTSE 100, but it's on the AIM index instead of the FTSE 250. And basically, when I looked into the numbers, like the costs were a concern, and I think that's absolutely the reason why the share price went down. But when you actually looked at the revenue, right, if you accept my rationale here that those three things are what's going to determine the share price, it was really good. Like, it was running ahead of expectations. Like, the growth in America and Europe in particular was fantastic. Actually, the growth in the UK, which has long been seen as a saturated market, was at 15%. So that's pretty great as well. Then, you had like success with other mixers. Like, it's become the largest ginger beer seller in the US. It's also, by the way, replaced Schweppes in the US as the largest tonic seller, a position it, did in the UK some time ago. So both of those things are promising. Likewise, their Fever Cola, I think, is freaking delicious. So there's that as well. And then likewise as well, their on-trade sales seem to be holding up like much better than I think even Fever were expecting. So like, yeah, okay, they need to get their costs under control here. It's sort of a combination of, freight, some FX unfavorable movements. Some ingredients have gone up, but actually what I'm seeing is a company that has no problem increasing its sales. It now just has to manage its costs a little bit better, and that is a concern. But I think a share price here under 20 quid just seems too good. Like that to me is an absolute steal. And because it's listed on AIM, I don't have to pay any stamp duty like I do on other shares. So that feels good as well. No 0.5% for me. So this just feels too good not to do, basically. And I had a look into the revenue and the costs, the report generally. And although I get why it fell, I think the fall was overdone as well. So yeah, I'm going to basically gingerly be building up my position here. Probably anything underneath £21 will still be a buy for me. I would like a bit of safety because I think sometimes they appear a little bit amateurish as a business. Like, I remember a few years ago, they were like, oh yeah, we've saturated the UK, or what should we do now? It was like, well, you should have seen this coming, really, right, guys? And again, like, things like cost pressures shouldn't be a surprise to anybody, not least a £3 billion business. Yeah, I think sometimes they can appear a little bit amateurish from that regard for a company of their size. But for me, again, this was a great opportunity to re-enter Fever after I sold out previously for 2,400, give or take. In the mid-range of my pretty wide estimates I accept. By the way, I sold out because not only was it in the middle, but I wanted to buy a bigger stake in National Express, right, at like 220, so that's what I did. No regrets there. And now I'm back in, and we're doing this. So I'm really happy with my buys, to be honest. Some of the things I wish I'd been slightly more patient on, but I mean, again, you don't really know what's going to happen with the market, and I'm just kind of taking this opportunity to average into many positions that a lot of the things here that I haven't highlighted I've already spoken about before. So I continue to buy into those positions. Even things like, I look down here and I can see like Scottish Mortgage Trust. Again, obviously that's a heavy exposure to NASDAQ, but again, to me it's a long-term win. So we'll continue to do that as well. So again, there's lots of things on here. Any questions in the comments below, and I'll address those as well. Let's move on to my sales. All right, so first of all, I haven't highlighted the top three just because I feel like I've spoken about them plenty in the past before. These are some of my larger holdings, so they get plenty of airtime, and I wanted to talk about some of the other ones. So I'll start with WH Smith, which is a company that does have existential issues related to COVID. It makes its profit because of its travel divisions and its rail divisions. However, there's a good underlying business here. And really I decided to sell because I had like a £15 14.90 I think it was buy price, so selling at 16.50 for a pretty short-term trade feels fine. Also as well, I suspect with this share price it's going to be all over the place for the next couple of years, so if I have a chance to buy underneath 16, I will continue to do so. To me, I think a medium-term target, like 1 to 2 years, about £19 is about fair. This is a company that traded as high as £24 before COVID, so I don't think it's an unreasonable target. But they've got profitable divisions elsewhere. It's just their retail travel arm is so dominant that that's really what matters for their profit. So they still aren't profitable making for 2021. We'll see what 2022 looks like, but again, for me this was just a chance to redeploy cash elsewhere, so I took it. Similar, I guess, although so Aviva I decided to sell half my stake. And to be honest with you, I more or less did a 1-for-1 directly into the other financials. This is my wife's ISA, so they went into JPM and Goldman Sachs, and a little bit extra in some other places too. But so it was more or less a move across the financial slides. And I think, to be honest with you, it's because I have 3 insurers: Aviva, Legal & General, and Phoenix. But Aviva is my turnaround play of those insurance, right? Legal & General is just a fantastically diverse and well-run business, and Phoenix is my niche play that is a high dividend yield, and I think is actually undervalued at the moment, and is actually growing and all the rest of it. With Aviva, it's done a great job of turning itself around over the last year. It's much improved share price. I've made some good money here. I do expect that by selling this, I'm basically doing myself out of a special dividend and everything else for these 400 shares. But in fairness, the market kind of knows this is coming, because Aviva's already promised to give back some of its divested businesses, as dividend to its shareholders. So the share price is probably running a little bit ahead of where it should be anyway. And so yeah, for me, I just decided to sell. I had a 420 target for this, so selling at 425 doesn't feel bad. I am probably doing myself out of maybe probably, I don't know, 40p special dividend, something like that. I mean, no one really knows what it's going to look like exactly. But again, I just decided here that I was okay with that. I do plan on closing my position down in AV fully, probably this calendar year, and in fairness, probably a lot sooner, probably once that gets announced and we get to see what the new business really looks like. But I decided to, this is a turnaround play. It was never meant to be a super long-term position. I'm happy selling here. And it was just a chance for me to buy other stuff. And frankly, if I get a chance to buy things like Google or Broadcom or Realty Income, all of those things are in my wife's ISA, where this is as well, I'm tempted to just sell down a little bit more. So yeah, don't be surprised if I continue to sell down Aviva. My reasons for holding them was the turnaround play. I consider the turnaround play more or less complete. The only thing the market is really waiting for is just some tidying up of the divested businesses, and hopefully a special dividend as well. So that's my reasoning here. Pets at Home, I just took a small profit, just a few percent. They released what I would class as solid results. The market liked them enough to consider them, actually one of the few things this week that had in line with expected results, and the market actually reacted positively, which was an unusual thing. That it went up too high, then it fell back too far. I was buying at 420, which felt good. So to sell here at 433, it's fine. It's 3%. Not exactly a huge profit, but for a couple of weeks' work, it's also fine. I do still consider Pets at Home a really fine business. I think anything under 420 should warrant somebody's attention. But I previously sold out 492. I think the shares went up to about 510, and then they've been falling back ever since. Similar, by the way, to Macerich, which, although it's a REIT, I wouldn't class as a normal REIT. This is a value play. And again, this was something where I was buying under $15, sold at 17.20, so that felt pretty good. And again, the share price fell back almost immediately afterwards, so again, that felt great too. But I think actually this is one for if you're a bit braver and fancy a little bit of risk, there's a good value play here, right? It's difficult to rate this business because it doesn't have too many competitors, and even its competitors are slightly different. Like Simon Property Group looks very different company. This Macerich particularly is over leveraged, has a horrible balance sheet, but is gradually moving in the right direction. So again, if you're a bit braver here, there's potentially a lot of capital upside. Something between 30 and 50% wouldn't surprise me at all. But for me, I wanted a quick release of cash and some profit very quickly, so I decided to sell. And again, I'm pretty much okay with this, but I will be tempted to add back into Macerich. Honestly, anything under $17 for me. And I guess I just want to close out by admitting I made a mistake with my last one, and I sold here for a loss of about 50%, so about 300 quid my loss here. This is Darktrace. I bought this near the peak. This is a UK listed cybersecurity company. I really bought it because I felt like it was a company I should have a stake in, but really what I mean by that is I felt like, oh, cybersecurity, that's a thing. I know nothing at all really about the sector, but there's this company I've heard of, so I'm going to buy. And I'm really annoyed with myself because actually it doesn't really have particularly good fundamentals. The actual company itself is not profitable. It's not it has a particularly strong moat or anything. It's not whereas I compare that to Genius, for example, does have a very strong moat, has exclusivity and all that other good stuff. Darktrace here is seemingly really struggling to make money in an industry that should be really growing very fast. And I just it's one of those things where I sort of look back at it and I'm like, what was I doing here? Really, I have no interest in it. I have no expertise in it. I obviously didn't do enough due diligence, and it was just I had a chance. I think I put this into Broadcom. And that's fine. It's such a better business. I just wish I'd bought another Broadcom instead of, spewing away 300 quid. So that's about the price of a Broadcom share. I mean, I don't have any excuse really other than just an explanation and kind of a warning for anyone else who kind of thinks, that's probably a sector I should be involved in. Like, if you're like, that's a weird rationale. Like, I know in hindsight that makes me sound like an idiot. I feel like an idiot, to be honest with you. Don't buy things that you just feel almost like subconsciously pressured into. Like, it's not like anyone made me buy this, but I felt like I should. And then even if that rationale has some kind of validity, you shouldn't be buying a company, just because it exists in a sector that you kind of feel like you should be in. It's just a weird sequence of events that I use to rationalize this. And clearly, on reflection, this is just a mistake. So I decided to crystallize a 3-figure loss here, my second largest loss that I've had after GAN. So that doesn't feel very good, but at the same time, it feels better to be in Broadcom, and that's fine as well. So yeah, I guess that's everything. A really long video, even by my really long standards. Hopefully those is interesting or useful. A really wild week, lots of trading, so that's been fun and stressful and mostly fun, if slightly battered feeling. So take from that what you will. Anyway, I hope everyone else is doing well. I've been the Boss Hog. Thanks very much for watching, and good luck with your investing. Bye for now, guys.